you. So passive investing has seen continued inflows despite the fact that rates are away from the zero lower bound. Despite the fact we're seeing more fragmentation across markets, we continue to see robust inflows into passive products globally. I think there's a couple of reasons for that. The first being that passive investment vehicles offer clients choice in terms of how they express market views. So there's a large range of passive products which enable investors to build portfolios with different risk-return characteristics. So I think that's very important for them. The second is in terms of innovation. So passive products help asset allocators, investors of various kinds, build portfolios which may have non-standard exposures within them. So for example, thematic exposures to tech thematic or other themes which are popular at any given moment in time. Also, it helps them, provides them with a way of incorporating exposure to ESG screened or sustainable funds of various kinds, so they can build portfolios which have very distinct sustainable characteristics. There are different factors which are associated with the real popularity of passive products and their explosive growth over the past few years. I think the first is the ease with which they provide access to specific markets. So investors can build portfolios or add exposures to specific markets very quickly and very easily using passive products. So they're important tools for getting market access in that respect, and that's both long and short. And with respect to many passive products now, there's a very rich options ecosystem which is being built around it. The second is with respect to innovation. So I think the range of market exposures that clients can get, whether it's the new breed of thematic exposures that investors can build into their broader portfolios, exposure to ESG, as mentioned, exposure to certain strategies such as factor-based or smart beta strategies, etc., give investors different ways of building portfolios with a whole range of different risk-return characteristics. I think passive products will continue to see inflows. The rate at which they see inflows may change over time depending on which strategies investors are interested in and which aren't. For example, over the past year or so, we've seen a notable shift in interest towards fixed income orientated exposures by virtue of the changing macro and markets backdrop. So I think interest in specific asset class level exposures will dictate the flow dynamic across the passive space. But I think broadly speaking, we'll continue to see robust inflows into passive products, even if inflows into active products pick up as a result of the fact that passive products are just tools for building portfolios, and investors are constantly changing their asset allocations, and as a result of that, we'll continually see inflows and outflows with respect to specific products. But as far as building portfolios which are broad-based, diversified, have different types of market exposures built into them, passive products are fantastic for building those types of rich, broad asset allocations. I think it's primarily because Europe is a little bit behind the US in terms of the evolution and development of the passive product space. I think it's growing very fast, so we're seeing significant and robust continued inflows into passive products within the European space, so the UCITS space more generally. That's accelerating. I think that will continue to accelerate. So I think Europe is really catching up to the US. I think there's a broad-based understanding that passive products are great tools, as mentioned, for building portfolios. They're very easy to use. Markets are very accessible using passive products. So I think Europe is just a little bit behind the US in terms of that growth, but will catch up very soon. I think you do see some differences in terms of appetite for specific products in the US versus Europe. In Europe, there's been more of a move towards sustainable products of various kinds. Ethical investment products more generally are very popular in Europe across the board. In the US, there's been a real move towards thematic type investment products, where embedding thematic exposures within portfolios has become increasingly important overall. So we're seeing continued inflows into both regions. I think we'll see continued growth in assets in both regions. I think Europe will bit by bit catch up with the US over time, but there may be differences in terms of investor interest between the two regions. So emerging markets are an interesting space for investors at this point in time, and will continue to be very interesting for investors going forward. We think going forward we'll see more fragmentation across markets, which means that asset allocations may become more granular over time. There may be more of a need for more tactical bets because of the way that the macro backdrop, the geopolitical, the political environment is evolving across the globe. So we see asset allocators taking more granular tactical bets either at the country level, the sector level, etc. Within the emerging market space, I think we'll see a lot more in the way of focused exposures across countries in particular within asset allocation. So I think passive products again give great easy access to emerging markets in different ways across asset classes and across countries. So I can imagine that single country asset class level exposures within emerging markets as well as regional exposures will become more and more popular over time. So I would expect inflows into emerging market focused passive products to continue to be robust, to accelerate over time, and for that space to become richer. So I think there are two immediate challenges which spring to mind. The accommodation of scale. So I mean, so far we've seen really tremendous growth in passive products globally across the board. The numbers are quite astounding. We're into the double-digit trillions in terms of AUM behind passive products, over a number of decades. So that growth has really been quite explosive, and it's accelerating. So I think scale in the sense of asset managers making sure that they can accommodate that AUM growth as it continues over time is important. But also we're seeing fragmentation in terms of regimes across jurisdictions and across countries, whether it's in the sense of regulation, whether it's in the sense of investor appetite, etc. So there are differences across countries and jurisdictions which asset managers need to be aware of and need to adapt to as changes take place. So I think we're probably talking scale in the sense of being able to accommodate the continued robust growth in AUM and also changing regulatory regimes across jurisdictions. Understood. Thank you. That's a good question. So I think the whole move towards ethical investing is not just a European phenomenon. We can see it taking hold in different jurisdictions. It will continue to do so. So there'll be a continued growth in sustainable strategies of various kinds. There's been a lot of emphasis recently with respect to climate strategies within the broader sustainable set of investment strategies, but also faith-based investment strategies are becoming ever more popular. We have a range of Islamic products which are very popular within the marketplace. So ethical investing generally, we think, will continue to be an important secular trend within the passive space. The thematic space is evolving as well. As mentioned previously, it's been a US-centric phenomenon for the most part, but it's very much taking hold in different jurisdictions as well, but to different degrees. So investors have different thematic products which are of interest depending on their investment strategies, and we can see differences in different jurisdictions, whether Asia, Europe, US, according to client preferences. But one area which has been very popular across the board has been tech thematic products of various kinds, in particular AI, unsurprisingly, more recently. But then there's active ETFs as well. So active ETFs are becoming more and more popular because they give investors a way of getting exposure to a specific asset class, But within the context of that exposure, they can have more than just beta exposure to that asset class through some type of possibly systematic stock selection methodology. They could have access to a quantitative or even a discretionary stock selection process, which can help them generate some additional alpha above the return of the market within that specific asset class. So we're seeing a surge in interest with respect to active ETFs as well. Sure. So the platform has grown quite significantly over the past few years. We're now the 7th largest ETF provider within Europe. We have more than $100 billion in assets under management within the passive space. We have a few flagship funds which have grown quite materially, core exposures. We have a broad range of core exposures on the equity and fixed income side. Our global aggregate fund is one of the largest out there. It's the largest UCITS fund of its variety, with over $12 billion of assets under management. Our MSCI World product is now over $7 billion in terms of assets under management. Our Eurostoxx product is now over $1 billion overall, and we have a multi-factor product, which is an active ETF, which has over $1 billion of assets behind it. So the platform has grown quite significantly. Our flagship products, key core products, have grown quite significantly, but the range of products we offer has also grown as well. So going beyond the core asset allocators toolkit that we also have a range of sustainable products, low carbon and Paris-aligned benchmark products, for example. We also have a factor and capitalization range for investors that want to get exposure to single factors within the context of their portfolios. We have a thematic range as well, which is growing, which is focused on very specific thematic type concepts, semiconductor, Hang Seng Tech, etc. So we're trying to broaden the product set according to our clients' needs and where we see demand in the marketplace for amongst our clients in terms of gaps that they have within their asset allocation.